When people invest and they put their focus on eye-popping returns, they forget a really simple fact. Ultimately, at some point, you will need money for that day when you are no longer working. And rather than this nonsense, the correct question is, how much do you need for 20, 25, 30 years, maybe more in retirement? That's not so far-fetched. Now that's a much trickier question than how to make 1,000% gain with this stock. So one way that people answer that retirement question is with something that's called the 4% rule, which means in year one of your retirement, you withdraw 4% of your account balance. And from then on, as the portfolio value changes due to growth, withdrawals, you continue along with that level of 4% withdrawal. And that does factor in inflation, by the way. This sounds pretty reasonable, right? Maybe. Now, there are possibly some issues with that, but the bigger point is you have to know how much you need to withdraw every year to cover your life expenses. You can't guess. So what factors go into this? Accounting for growth, for inflation, and to have a portfolio that's aligned to your time horizon and risk tolerance in the first place. Not just some willy-nilly collection of stuff that you like because it's done well. And I know the thought process here. It's doing well, so I'll keep it, and when it stops doing well, I will sell. Now, sometimes that can work, but it sounds too easy, doesn't it? It's like all of these things that sound super easy. If it were, everybody would do it. Bada bing, bada boom, and nobody would ever lose money in the market or ever own a poor performing investment. And you know that's not true. So that's where it's so important to have a plan and where this 4% rule comes in. But here's what I was talking about a second ago. The problem with just saying, I'll withdraw 4%. For starters, it assumes that your portfolio is properly allocated to accommodate for your risk tolerance, time horizons, and your goals. But as I just mentioned, the overwhelming majority of portfolios, and I've seen a lot, by the way, are just a bunch of stuff all cobbled together for a whole lot of reasons. But usually, there's no purposeful strategy behind it. And that's even if you think there's a purposeful strategy because you believe something's going to do well. That's not proper allocation. So in addition, you have to be cautious about today's situation with interest rates being kept near zero through 2023, which is what the Fed has said. So that means the yield from your bonds will be lower. Falling interest rates makes bond prices rise and bond yields fall. And that does affect the income your portfolio generates. You might not remember, but there was a time way back in the past when bonds were considered safe. There was the so-called widows and orphans portfolio, which consisted of bonds. It was designed to be low risk. Now today, and for a long time actually, the risk of bonds has been that you will not keep up with inflation and you will not generate the return you need for that long retirement. Remember, maybe 30 years or more. So all of this relates back to simply withdrawing 4% every year. You cannot just throw this into a spreadsheet, do that equation of a 4% withdrawal and think you've done your job. This is a job for a real financial planner and not just one who is really an insurance salesperson whose plan shows, hey, you need to buy an annuity from them. No, you need to see a fiduciary about that. Another problem with the 4% rule is the reality of spending. Now, I can't tell you how many times I've been meeting with a client and they've nodded in agreement when I present a financial plan with spending levels they can afford all through retirement. And that incorporates a new roof, a new car, things we know they're going to need. It's not pie in the sky. But later, maybe it's weeks, maybe it's months, I'll hear that the client made a big financial decision that was nowhere in their plan. Now, we could easily have run those numbers to get a better understanding, and a lot of clients do ask about that. But like everybody else, my clients can exercise their freedom of choice, and that includes, unfortunately, the freedom to make unwise financial decisions sometimes. Don't be that person. Find a fiduciary planner and work with them. Now, I totally understand. Legit spending needs do pop up. I mentioned the new roof. Maybe you want that shiny new Tesla sooner than you thought. Maybe you need to take some personal money and invest it into your business. You want to maybe help out your family if somebody needs help. There's plenty of examples like that happen all the time, but that could throw the 4% rule into disarray. So where does that leave you? If you're planning to retire soon or are already retired and you want to understand how much you can spend and how much you need to have invested. Keeps coming back to that plan, my friends. Start with a comprehensive financial plan that evaluates all aspects of your financial situation. And this will give you a baseline of how much you'll need and how much risk you'll need to take to generate the necessary return. Oh, and by the way, how much risk you shouldn't take to generate that return, okay? Now, should you incorporate the 4% rule? Maybe, but it shouldn't be your default starting point. Okay, thanks so much for watching. And I have something for you. If you want a guidebook that I created for my financial planning clients, it's yours for free. kickthebucketbook.com. That's at kickthebucketbook.com. And hit that like button. Everybody needs to be seeing these videos. Thank you so much for watching. Have a great day. Be careful out there. Thanks for watching. Don't forget to subscribe, like the videos, and hit that alert bell so you will know every time a new video is released. Thanks again.